Complex financial institutions are fundamentally different from all other businesses. They perform essential and highly subsidized public functions. That's my first point. Second, of course, their liabilities are money. They are guaranteed both by governments through deposit insurance, which is effectively universal and much wider than it is explicitly, and of course by the institutions of central banks. And their assets are, of course, the economy's lifeblood. With extraordinary frequency, there have been well over 100, and don't treat this as a purely US issue, there have been well over 100 major banking crises, effective insolvency of entire banking systems in the world as a whole in the last 30 years. Their impact on public finances and the economy is remarkably similar to that of a war. Governments always intervene if they have the means. They are themselves solvent to rescue banking systems. There are virtually no exceptions to that rule, even in this citadel of capitalism here in the US. And as Carmen Reinhardt and Ken Rogoff have pointed out, the direct and indirect fiscal costs of a major banking crisis tends to end up by doubling the quantity of public debt, and to be associated normally with very long recessions lasting on average in the developed world 5 years. 12 regulators have an absolute right to look at the structure of pay along with other aspects of the complex financial institutions that the government has decided are too big to fail, God damn it, because they represent, and I repeat this, because the regulators represent the interest of the risk bearers of last resort in the financial system, which are and will remain, without question, the taxpayer. Thank you very much.